What if I told you that the biggest investment fund in America never invested a single dollar? For nearly 20 years, thousands of people believed they were getting richer every month. Billionaires trusted it. Hollywood celebrities recommended it. Universities invested in it. Charities depended on it. Even some of the world's largest banks believed it was real. Every account statement showed steady profits. Every client felt safe. Nobody suspected that the money they thought they had didn't exist. Then on December 11, 2008, the illusion collapsed. In just a few hours, more than $65 billion disappeared, exposing what would become the largest Ponzi scheme in history. The man responsible wasn't hiding on a tropical island or operating from a secret office. He was one of the most respected figures on Wall Street. He had helped shape modern financial markets. He had served as chairman of NASDAQ. His name was Bernie Madoff. But this isn't simply the story of a financial fraud. It's the story of how one man manipulated trust so perfectly that thousands of intelligent investors, powerful institutions, and even government regulators failed to see the truth for decades. So the real question isn't why Bernie Madoff got caught. The real question is, how did nobody catch him sooner? To understand how Bernie Madoff fooled the world, you first need to understand why nobody questioned him. Born in Queens, New York, Madoff founded Bernard Madoff Investment Securities in 1960 with just $5,000 he had earned working summer jobs. Unlike many brokers of his generation, he embraced technology long before Wall Street realized its potential. His company became one of the pioneers of electronic trading, earning both profits and prestige as financial markets evolved. Success brought influence, and influence brought credibility. Eventually, Madoff became chairman of NASDAQ, one of the most respected positions in American finance. To investors, that title meant one thing: trust. If the financial establishment trusted Bernie Madoff, why shouldn't everyone else? Wealthy families recommended him to friends. Private banks introduced clients to his firm. Investment funds proudly claimed to have access to his exclusive strategy. The more respected people invested with him, the more impossible it became to imagine that anything was wrong. Madoff understood a simple psychological truth. People don't trust someone because they verify the facts. They trust someone because everyone around them already does. That single idea became the foundation of a fraud that would survive for decades, and his next move would make questioning him almost impossible. Most investment firms spend millions trying to attract new clients. Bernie Madoff did the exact opposite. If you wanted to invest with him, the answer was often no. There were waiting lists, referrals were required. Even wealthy investors were told there simply wasn't enough room. That rejection had an unexpected effect. It made people want in even more. Psychologists call it the scarcity principle. The harder something is to obtain, the more valuable it appears. Soon, gaining access to Madoff's fund became a status symbol among the wealthy. Exclusive country clubs whispered about him. Hedge funds proudly claimed they had connections. Investors weren't asking whether his strategy made sense. They were asking how they could get an invitation. The mystery became part of the product. Madoff rarely explained how he generated such remarkably consistent returns. Clients didn't mind. They assumed that secrecy was simply the price of brilliance. After all, if he revealed his strategy, competitors might copy it. That explanation sounded perfectly reasonable. But while everyone admired the exclusivity, almost nobody noticed something far more important. The person managing billions of dollars wasn't allowing anyone to independently verify what he was actually doing with the money. And somehow, nobody insisted on seeing the evidence. Every investor knows one rule: markets move in cycles. Some months are exceptional, others are disastrous. Even the greatest investors in history experienced painful losses. Bernie Madoff didn't. Month after month, year after year, his clients received almost exactly what they hoped for: steady gains, remarkably low volatility, and almost no surprises. It looked like the perfect investment. Too perfect. While the S&P 500 surged or collapsed, Madoff's statements barely changed. During market booms, he made money. During downturns, he also made money. His returns seemed almost disconnected from reality. Instead of raising suspicion, this extraordinary consistency attracted even more investors. People believed they had finally found someone who had mastered Wall Street. Few stopped to ask the obvious question: if generating these returns was truly possible, why wasn't every investment firm in the world using the same strategy? The answer was simple: they couldn't, because the strategy existed only on paper. The account statements were carefully fabricated, the trades were largely fictional, and the profits were nothing more than numbers typed onto a page. But while almost everyone accepted the illusion, one man looked at the data and immediately realized something was terribly wrong. His name was Harry Markopolos. In 1999, while thousands of investors praised Bernie Madoff as a financial genius, one little-known analyst reached a completely different conclusion. His name was Harry Markopolos, a derivatives expert from Boston. He wasn't trying to expose a fraud. In fact, his boss had given him a simple assignment: reverse engineer Madoff's investment strategy so their own firm could compete. But after only a few hours of analysis, Markopolos arrived at a shocking conclusion: it couldn't be done. The returns Madoff claimed to generate were mathematically impossible. His strategy, known as the split strike conversion, simply could not produce such consistent profits under real market conditions. There wasn't enough trading volume in the options market to support the enormous positions Madoff supposedly held. The numbers didn't add up. Convinced he had uncovered one of the largest frauds in financial history, Markopolos repeatedly warned the U.S. Securities and Exchange Commission. He sent reports. He explained the mathematics. He even provided a list of red flags investigators could verify in a matter of hours. Yet every warning was ignored. While regulators looked the other way, Bernie Madoff continued attracting billions of dollars. The greatest opportunity to stop the fraud had come and quietly slipped away. If Bernie Madoff wasn't making real investments, where did all the money come from? The answer was surprisingly simple. New investors were unknowingly paying the old ones. Whenever a client wanted to withdraw money, Madoff didn't sell profitable investments because there weren't any. Instead, he used deposits from newer clients to fund the withdrawal. As long as more money kept flowing in than flowing out, the illusion remained intact. Fake account statements reinforced the deception, showing trades that had never happened and profits that had never been earned. Clients believed their wealth was growing, so most of them left their money untouched, allowing the scheme to expand year after year. The remarkable part wasn't the mechanics of the fraud. Ponzi schemes had existed for decades. What made Madoff different was the scale. He convinced some of the world's most sophisticated financial institutions to feed him billions of dollars without demanding independent proof that the assets even existed. Reputation replaced verification. Trust replaced evidence. For years, that was enough. But every Ponzi scheme has one fatal weakness. It depends on a constant stream of new money. And in 2008, the global financial crisis would suddenly bring that stream to an end. For years, Bernie Madoff had survived every market crash, every recession, and every wave of investor withdrawals. His fraud relied on one simple assumption: enough new money would always arrive to cover those who wanted to leave. Then came 2008. As the global financial crisis spread across the world, panic replaced confidence. Banks failed. Stock markets crashed. Investors desperately needed cash. Clients who had trusted Madoff for decades suddenly began requesting billions of dollars in withdrawals at the same time. This time, there weren't enough new investors to keep the illusion alive. The flow of money that had sustained the scheme for nearly 20 years simply stopped. Behind closed doors, Madoff realized the truth he had managed to postpone for decades. There was nothing left. The accounts were empty. The billions shown on client statements had never existed. His empire wasn't collapsing because investigators had uncovered the fraud. It was collapsing because the mathematics of a Ponzi scheme had finally caught up with him. After years of escaping regulators, journalists, and financial experts, Bernie Madoff had been defeated by the one thing he could never manipulate: reality. And with no possible escape left, he made a decision that would permanently change financial history. On the evening of December 10, 2008, Bernie Madoff called his two sons, Mark and Andrew, to his Manhattan apartment. Both worked at his investment firm and believed the legitimate market-making business was exactly what it appeared to be. They had no idea that another part of the company had been built on fraud for decades. Sitting quietly in his living room, Madoff finally admitted the truth. There was no sophisticated investment strategy. There were no hidden profits waiting to recover. The business, he confessed, was one big lie. His sons sat in stunned silence. Everything their family had built, the reputation, the wealth, the respect, collapsed in a single conversation. The following morning, they made a decision few people ever imagined having to make. They reported their own father to federal authorities. Hours later, FBI agents arrived at Madoff's apartment and asked him a simple question. Is it true? Without hesitation, he answered, yes. Just like that, one of the greatest financial frauds in history officially came to an end. But while Bernie Madoff's confession closed the investigation, it opened a far more important question. How could so many intelligent people have believed him for so long? When Bernie Madoff confessed, the headlines focused on one number, $65 billion. But behind that figure were thousands of real lives that would never recover. Retirees who had spent decades saving for a comfortable future suddenly found their accounts empty. Families were forced to sell their homes. Small business owners lost everything they had built. Charities that funded hospitals, schools, and medical research shut their doors almost overnight. Some organizations had invested nearly all of their endowments with Madoff, believing his steady returns would support their missions forever. The damage spread far beyond Wall Street. It reached ordinary people who had never heard of a Ponzi scheme until it destroyed their financial future. The emotional toll was just as devastating. Lifelong friendships ended in accusations and guilt after friends unknowingly convinced friends to invest. Families turned against each other. Several victims, overwhelmed by shame and financial ruin, took their own lives. Even Madoff's own family was shattered. His sons became targets of public outrage, despite reporting their father to authorities. One later died by suicide. The other passed away after battling cancer. The greatest Ponzi scheme in history didn't just erase fortunes, it destroyed trust, relationships, and lives. And in the end, perhaps that was the most devastating loss of all. It's easy to think Bernie Madoff succeeded because he was a financial genius. The truth is far more unsettling. His greatest weapon wasn't mathematics, investing, or even deception. It was human psychology. People trusted him because everyone else trusted him. Wealthy investors assumed banks had done the research. Banks assumed regulators had verified the numbers. Regulators assumed prestigious institutions couldn't all be wrong. Responsibility quietly shifted from one group to another until no one was asking the questions that mattered. Madoff didn't sell extraordinary returns. He sold certainty in an uncertain world. He gave investors exactly what they wanted to believe: stable profits, low risk, and complete peace of mind. That promise was far more powerful than greed. It appealed to trust, and trust once earned can become more dangerous than suspicion. Bernie Madoff was eventually sentenced to 150 years in federal prison, where he died in 2021. His fraud may have ended, but its lesson remains as relevant as ever. Every financial bubble, every scam, and every too-good-to-be-true investment begins the same way, with people choosing confidence over verification. Because the biggest lie Bernie Madoff ever sold wasn't that he could beat the market. It was that someone else had already checked the facts.